This week, I am going to go over the progression of how we analyze the markets while at the same time trying, as best we can, to ignore the militaristic flurries throughout the world. I say militaristic flurries, but I do not want to minimize the loss of human life and property and the negative effect on quality of life that is sure to last for some time. It can always be discussed why Israel attacked Iran, or possibly who motivated this conflict due to oil or some other speculated directives. But it is not a comfortable situation to anyone, and we certainly hope for a quick resolution. As I write this, President Trump thanked Iran for letting the U.S. know that they were going to bomb Qatar and that no lives were lost and nobody was injured. And within 12 hours of the bombs being dropped, Qatar airspace was opened back up for commercial travel. Prior to this attack in Qatar, and after the 3 nuclear facilities were destroyed in Iran, I put pen to paper about my opinion on the conflict. My assumption has been that Iran would not close the Strait of Hormuz because Iran needs revenue. Closing the strait would deprive them of that revenue and could anger its biggest customers, particularly China. Iran represents 80% of China's imported oil. Iran doesn't have many friends. Shutting the strait doesn't directly impact the U.S. because the U.S. doesn't need oil from the Gulf. Closing the strait could hurt Iran more than it would the U.S., which is why I remain skeptical of a sustained rise in oil prices. On Monday, after the bombs were dropped in Qatar, oil promptly dropped by over $5 per barrel, almost 8%. Additionally, Trump needs low oil prices to make his domestic agenda work. So U.S. attacks on Iranian oil infrastructure seem low, but anything can happen in armed conflict. With the news flow moving quickly, I will limit my comments to 3 topics. First, are there good historical analogs for what occurred over the weekend? Although no 2 events are the same, I extracted the instances from the crisis events table that was put together by the team at Ned Davis Research that were closest to this weekend's event. The instance of the conflict normally creates defensive action in equity markets initially. Monday of this week was a perfect microcosm. The markets opened Monday down about 1% on the heels of the U.S.'s attack on the nuclear facilities. The markets recognized that oil facilities were not damaged and human life was spared. S&P quickly recovered higher to reverse the decline and rise close to 1% above Friday's close. Then the 6 bombs were dropped on Qatar. The markets immediately reversed and were down once again. Reports came that there were no deaths and no injuries, and stock prices reversed once more, with the indexes closing up almost 2% from Friday's close. In looking at the table here, it can be seen that stocks were mostly higher over many different time periods. I was quite impressed by the team at NDR as they covered virtually every conflict going back to 1900. Second, as I have written previously, this year I have mainly focused on one of my favorite sayings, don't fight the government or the Fed, and what guardrails there might be around policy, if any. In addition to financial guardrails, my assumption has been that Trump would listen to his MAGA base. The hurdle is high for a 2003-style ground invasion. In his brief statement on Saturday evening, the president wanted to avenge the deaths of many Americans at the hands of Iran, given that diplomacy no longer seemed to be working over Iran's nuclear program. Third, we need to understand the positioning of the market going into this event. Bond sentiment was moderately pessimistic. The Fed seems to be working opposite to the president's vocal commentaries on the desired direction of interest rates. And even though inflation remains subdued, interest rates remain stubbornly high. We wouldn't expect a major move to the downside in bond prices, yields higher, considering the flight to safety bid. Crude oil sentiment, however, has remained neutral, and Monday morning oil prices actually fell, so again, a quasi-non-event. Crisis events, Dow Jones Industrial Average declines, and subsequent performance. The list here, which I mentioned earlier, is quite extensive, as it covers virtually every conflict going back to 1900. please feel free to look for virtually every conflict that has transpired. At the end of the table, the amount of the decline is provided on average. And then the return of the markets, 22, 63, 126, and 253 after the beginning of the crisis. This is a table provided by NDR Research. I took the liberty to attach it to this report for illustration purposes. The financial markets. Now that we have addressed what I feel is most current and pertinent about the international conflicts, I wanted to make it clear what we look at from a financial markets perspective. Of course, conflict must be recognized and handicapped in the markets, but at the end of the day, the money is going to go where it is treated and expected to be treated best. Strangely enough, besides the tariff tussle that the markets experienced in early April, the S&P 500 seems to be just biding its time and catching its breath since November of last year. This has been almost 3/4 of a year. Oftentimes, a move sideways will achieve the same energy rebuilding effect as a moderate correction can. Ari Wald this week made an important point that is being bantered about in the financial press. Is this current price of the S&P 500 a top that is forming, or is it ready to break out to new highs after this 8-month digestive phase? This is really what is driving investors crazy. There have been more than enough reasons for the markets to go down, but they aren't. And if you can recall the statistical studies that I have provided, along with the amount of cash on the sidelines, there are a few really strong reasons for the markets to go higher. The S&P 500 is less than 3% away from its all-time high, 6,147, set in February. My primary concern is that the rally since the April low has been undermined by narrow internal breadth. What I mean by this is that the companies that led in the move off the April lows have not been joined by the next group of smaller companies that have still not been participating. Last week I mentioned that after 16 years of U.S. equities outperforming foreign equities, the large, high-quality foreign companies started a move outperforming the U.S. companies. Well, this changed in the last couple of months, and now relative to the S&P 500, the world ex-U.S. has begun to pass the baton to the big U.S. growth companies once again. Signs of rotation back into U.S. growth in March have mirrored past periods where world ex-U.S. outperformance had generally marked opportunities to rotate back into the U.S. over the prior 20 years. We see this as a potential resumption of a long-term trend that still favors growthier benchmarks like the S&P 500. To then take this from a comparison of U.S. to world ex-U.S. to a measure of what in the U.S. markets are pulling them back to a level of strength, it can be seen in the action of the pure growth NASDAQ 100 and its comparison to the S&P 500. I do this since the driver of the broad U.S. markets have been the bigger growth types of companies. The clearest sub-index to use for this analysis is the NASDAQ 100. Please take the time to recognize here how not only has the NASDAQ 100 started to blast out to new highs, but in the lower part of the graph, relative to the S&P 500. This index has been moving sideways since the beginning of 2024 and is now breaking out to new highs. If we are to take one more layer off the onion, it can be seen in the comparison of sectors here that besides utilities, technology, and communication services are the clear leaders year to date in the index. I find this particularly important to not only know where an investor should likely hunt, but also where the market has had strength that has been masked by a near zero performance overall year to date. One of the last studies that I find of great importance is the next question that an investor may ask. Okay, we know that growth companies are back to doing the best of overall U.S. companies. And we see that the U.S. seems to wanting to take the lead from the world ex-U.S. companies. Which sectors are driving this move? But should the focus be put on the biggest companies, the medium-sized, or the small-cap companies? To answer this, I look at the table here, which compares these against each other. As can be seen quite obviously, the leader is clearly large-cap growth. I am sure that the international conflicts are not over, and that it might take some time to reach a ceasefire between Russia, Ukraine, and the Palestinian conflict. But stateside, our economy seems to be doing fine. First quarter earnings were better than forecasted, and second quarter expectations seem to not be ratcheted lower. This could provide a backdrop for further upside in our equity markets. The last thing I wanted to share was a fascinating Q&A between Martin Armstrong of Armstrong Economic and an undisclosed person. It is in regard to the Iranian conflict as a whole. If you wish, please take the time to read this answer. I found it quite interesting as Mr. Armstrong addresses many issues of the different factions that exist in the Middle East.